Oh, we started everything muted. So for the recording, we started muted. We did the Pledge of Allegiance and Ed called the meeting to order. GK, who is remote. Paul, is that you or is that somebody else?
They're muted as well.
All right, we'll go.
Yeah.
We figured it out. We figured it out.
I think they're muted.
They are muted.
Yeah.
No,
We're mute them.
So,
if they're muted, they can't hear us.
well, that we can't hear them if they're muted. But
Ask them to identify themselves.
yeah, they don't necessarily have to, but we can't assume it is Paul. So the minutes will just show him not being here unless we figure out it is Paul.
Okay, could be Paul.
Could be Paul.
We just don't know. All righty, what I was doing is I was saying consideration of the special meeting of minutes from 7/30/25. I have a copy here. Has everyone had a chance to look at it? Are there any changes or anything that you want to make a comment on? If it's not right. Okay, do I have a motion to approve it as presented?
So moved.
Second?
Absent.
Okay, all in
I was
favor?
absent.
Huh?
So Ed, you second.
Okay, I'll second it. All in favor?
Aye.
Aye. Okay, so move.
You have to abstain.
Yeah.
Okay. Next thing on the agenda is the 24-25 pension valuation actuarial report for the town, the police, the LoSAP. Okay, I guess you're on.
Okay. I'm Scott Lindbergh from Milliman, and I'm here with Elena Pelletier today. So she's going to be taking over for me on the day-to-day work for your two plans. I'm going to be focusing more on OPEB and health work going forward. So I wanted to introduce her today, and she's going to give the results for the 2025 valuations for the police plans.
Now I know we're in trouble because you got your computer there. See?
Yeah, try to be green, although we certainly killed some trees.
Yeah, so
yeah.
and, that's on me.
We got all the bases covered. All right, so good afternoon, everyone. Like Scott said, I'm Elena Pelletier. I've been working with municipal pension and retiree medical plans for about 20 years now. I've been at Milliman for maybe 6.5 years, and I look forward to working with you. But enough about me, let's talk about your pension plans. So today we're going to be going over the results of the July 1st, 2025 valuations for the two plans. I'm going to start with the town plan and go through that one in a little more detail, and then just kind of go over the highlights of the two plans. We don't have to hear the same thing twice. All right, so let's start with that one. So when we perform an actual evaluation, we take the inputs, which are the census data for the plan members, the plan's assets, we combine it with our actuarial assumptions, and we calculate a liability, and then we look at your funding policy and calculate your actuarially determined contribution. So my presentation is going to go over each of those pieces in turn. So changes in the census data, changes in the assets, and then the results. But before we get into all of that, I just want to give you the 10,000 foot view. You know, if you forget most of what I said, here are the key takeaways. It was a good year for the assets. We had a 10% return for 24-25. The funded ratio went up. You're 92% funded. That's the plan. And we made one small assumption change, which was to update the mortality assumptions in the latest table. And that had a small impact that actually lowered the liability slightly.
So
Can
just
I,
on that part,
Yeah.
sorry, Ed,
no, go ahead.
the board is gonna have to vote on making that change.
Sure. So that's, let's say our proposal is to make that change.
Okay. Did the
And-
mortality change lengthen? Was that what kind of did it?
No,
It
so
went out a little, or not?
actually, yes. So the way I would describe it is the mortality table has improvement built into it. So there's a base table and then there's an expectation for mortality to improve in the future. And the prior table overestimated how much mortality improvement that would
Okay.
be. So pulled it back slightly.
Oh,
You might recall the table we're using is specifically based on public plan experience. It's called the PUB 2010 table. And the Society of Actuaries periodically updates that. So this was just an update to that table with extra 6 years of data. So it's a small change, but it did have the impact of shortening life expectancy for most groups.
Hmm.
For police, it actually, for some police, we do use a safety table. There's different versions of this table. For public safety, it did extend lifetime.
But this is a 2016 table, so it isn't taking into account the effects of COVID.
That's right. It is not, yes.
So that was not part of what lowered the growth assumption.
No,
That's sort of interesting.
Yeah, it is interesting. And the actuarial community is still kind of hasn't reached a consensus on the post-COVID mortality expectations because there's kind of things going in opposite directions. There was excess deaths, but then there were fewer deaths than expected in the following few years. So what we assume in the future post-COVID, I was yet to see what the consensus.
Well, my understanding of that COVID, a lot of nursing home people died. And there
No,
was a
that's
lot of
definitely
aged
true.
people
Yes.
that were more affected than younger people.
And that's part
Yes.
of what the results are seeing is too, is that there's excess deaths during COVID, but they think that a number of those deaths may have been people that were more susceptible to dying in the first place. And so then now you're seeing less deaths following COVID, probably because some of the people that may have passed away in a couple of years, COVID.
Yeah, well, no,
From
it
that.
accelerated their,
But this 2016 table in any event does not cover that period at all.
no.
Yes.
So
And what you're saying is it could be moved.
Yeah, we do expect periodic updates to this table. So perhaps in a few years, we'll be suggesting. another tweak. Okay. Good questions already. All right, so let's get into the detail on page 2. So here we're looking at the plan membership. And in the top left corner, we've graphed 3 classes of members. We have the active members on the bottom, that's in that dark blue. And you'll see that that bar has been going down over time. And that's because we're looking at the town plan, which is closed to new entrants. So new employees that you hire don't go into this.
it's closed to new entrants, but not frozen.
Correct.
No, it's not
Yes.
broken.
The people that are in it are still accruing benefits, but no new people are coming into the plan.
Right.
So that's why you're seeing that trend of active members going down over time. 47 of them as of July 125.
Yeah, the new employees, well, I think it's been 5 years now, hasn't it?
It's been 10.
Has it been that
If you
long?
look, there's been, in the years of service chart, there's nobody under 10.
That's
Okay.
Technically, most of it changed in 2016, but I don't think we had, like, I was hired in 2011. There's somebody hired in 2012, the senior center director, and then we haven't had anybody else hired in that bucket that stayed long enough to qualify. They're gone. So,
I
And
think
what
the
they're
latest
doing
hire
now,
that's still active is 2014.
yeah,
yeah, and what they're doing now is a 401k plan
correct.
with contribution by them and the town.
Yes.
And then a 457 elective if they want to do it.
Yeah, we've always had a 457 elective. So that's available to everybody, pension or
Right.
non-pension.
Yeah.
So,
And people can double up on that, you know,
correct,
and that's a loophole the IRS has not shut down.
correct.
Anyway, go ahead.
All right. Next, light blue, we have, these are your members in pay status. So these are retirees or beneficiaries that are collecting a benefit. And that group is growing over time as active members retire. And then lastly, you have this little slice of terminated members that used to work for you, but and are due either an annuity or just a refund of their contributions, but they haven't yet started to collect a benefit. So there's 15 of those members. As far as activity during the last plan year, there were 6 retirements, 2 terminations, and 3 retiree deaths, which was all close to what we expected using our actual assumptions. Moving on to a little more detail on this page, like Brad already pointed out, we have a table at the bottom that shows active members by age and service. And again, I think that's just telling us the plan is closed. Most of the members are older and longer service employees. And for members in pay status, you have mostly service retirees, a handful of beneficiaries. And in total, you're paying out about $3 million in annual benefits. And that's why we're all here, to make sure that we can pay those benefits. That is all I had on the census data.
Can I ask one question?
Sure.
Brad, we don't have any retirement age in of the employees? In other words, they don't have to retire by a certain age.
No, so right now, the only rule is Rule 75.
Okay,
So it takes 10 years to vest, so obviously everybody's in that at least vested bucket. But to actually start collecting, you still need to be the Rule 75.
okay,
There's some like, if you take early retirement, but basically everybody's in that Rule 75. Okay.
All right, now moving on to the assets. So like I said, this past year was a good year, 10% return. We assume a 6.5% return, so that's, quite a healthy gain. And in fact, that was about a $1.5 million gain on the assets. And the previous 2 years were equally strong. And I think the past few months, I assume, have been fairly good for your assets as well. Yeah, see a thumbs up.
You're jumping ahead to Mike's.
Yeah, sorry. Don't want to steal anyone's thunder. But looking back at the prior 2 years, there was one bad year, one great year. And, that's what assets do. There's volatility. Assets go up and down. What we do for the purpose of our pension calculations is we smooth some of that volatility out and use an actuarial value of assets instead of a market value to do our calculations. And that actuarial value of assets recognizes those gains or losses over 5 years. So instead of recognizing it all at once, we smooth it out. And you can kind of see that in the graph on the bottom, where the dark green are market value. And you can see that drop that happened 7/1/22. And then assets have been going up since then. And the light green has been a little smoother, so that that volatility does not translate as much into your contributions for year to year.
So that's 6.5% expected actuarial rate of return, is based on your assumptions about our asset mix.
Yes.
So that will change if we make the decision to adopt.
The 6.5 is based on what this board says is their expected. The
Okay.
smoothing is, because that was one of my questions, because it's not on here anywhere. Do you know what what that rate was for this past year? Obviously, it was lower than the 10. Because you can
What
see the
return on the
1.499.
actuarial value of assets was, I do have it in my notes. If you want to give me a second. That's why I would bring the computer. 8.4%.
okay.
Yeah.
And we've actually brought that down over the years to that 6.5.
Yeah,
It had been
Yeah.
over 7, I think, at one point.
yeah, but to Myra's point, the 6.5 is based on what this board is assuming,
Right.
not based on, and that's what they're basing their future calculations on.
Right. And we make a recommendation as to what we think is appropriate, which is actually the next page. But
Exactly.
Right.
yes.
yeah, it is the board's decision.
I think
but
what I
as an
want to
assumption.
understand, because this is my first time, we're contemplating a change in the asset allocation of the plan based on recommendations
Right.
from Morgan Stanley. And so I'm trying to figure out whose assumptions we want to be looking at for the asset allocation.
When we put together the asset allocation with OCIO, we're looking at the 6.5 and going the other way with it.
Right, right. So,
Right.
I mean, but, so you're proposing one asset allocation that would, where the expected return would be 7.
Yep. You got it.
That's your.
This is a critical input to our,
Right,
creating
so,
a
so
report.
I'm just trying to understand the interplay in the decision-making process between what you guys recommend and what you guys are coming, because when you're coming back to us, you're also looking at your own assumptions for asset returns,
It's on the next page.
right?
Yeah,
so as part of our actual standards of practice as actuaries, we need to feel good about the assumptions that we're
Right.
using and comment on whether we think they're appropriate. So while the board sets that assumption, we do review it every year to make sure that we feel it's appropriate. So if you were to change your target asset allocation dramatically, our analysis might return a different expected rate of return.
Yeah, Myra, throughout the year, Scott will check in and confirm with me, and so does my compliance people, of was there a change in the asset allocation?
Right,
So you've been
right.
coordinating.
Yep.
That's,
Yeah, but that's a very good question.
and by bringing it down to 6.5 like we did, that's conservative. We try to be more
Yeah, it's quite
conservative. And if we beat them, and if what they're recommending the changes, if you look out on the out years on both plans, it builds the total amount and it kind of accelerates over the decades, if you go way out. And that's what, one of the reasons why they're gonna ask about this change. We'll get into it later. But what we're trying to do here is see if we can get more coverage and build it higher and get less liability.
Sure.
In other words, bring it up from
Well, it's a
92% to maybe 98% or something like that.
You're looking to improve it.
Right, and the prudent investor rule, yeah. Okay,
All right, so just one more comment on where we ended up. So I mentioned that we had these losses a few years ago. With the gains that you've had in the last 3 years, you're now at a net gain position. So you recognize those older losses that occurred. All right, moving on to the next page for the discussion that we just started. So this is our review of the interest rate assumption. The picture at the top is just a pictorial representation of your target asset allocation.
Mhm.
So the different bubbles represent different asset classes. So in green, you have fixed income, which currently is a 40% target in your portfolio. And then you have various equity categories in blue. And we've graphed them according to their expected return and their volatility. So as you can expect, the equity bubbles have a higher expected return, but also a higher volatility. And the fixed income is lower expected return, but also lower volatility. So we take this asset allocation, we combine it with our capital market assumptions, which is our expectations of what these asset classes are going to return in the long term. And, we're not looking at the next 3 or 5 years. We're looking 20, 30 years out because these pension plans are going to be paying benefits for decades to come. And when we look out over a long time horizon, the good years and the bad years mostly even out. And kind of the middle, what we expect this portfolio to return is 6.6%. And this is based on, July 125 capital market assumptions. We do this every year. As the market outlook changes, this changes from time to time. We don't necessarily want to change our interest rate assumption every year, and we don't want to keep moving that around. So this is just kind of a marker to make sure that the assumption is reasonable. And we feel that it certainly is at 6.5%.
I think the state at a conference I was at recently, they're high sixes for their state employees still.
Yeah, and they might have a different target asset allocation.
Yeah.
They might be less conservative with their assets too. But yeah, you're right. There's certainly some plans that are closer to 7. There's some plans lower than 6.5. So yeah. So the other assumption I want to talk about was the mortality assumption, but we already covered that in detail. So I will go on to the next page, which is the liability.
Mhm.
So the top 2 graphs are showing you the same information, just the one on the left has a total liability and the one on the right breaks it down by member status. The liability as of July 125 was 45.7 million. Now we expect the liability to go up from year to year as members accrue more benefits. And you can see that it has been going up slightly and it's kind of almost leveled out. And that's happening because this is a closed plan so that there's little amount of benefits being earned from year to year. And in fact, in the next couple of years, we expect the liabilities to start to decrease as the benefit payments to retirees outweigh those new accruals by active members. So you're kind of approaching the top of the liability curve for this plan. So using our assumptions, we expected the liability to be at 45.8 million. So we came out almost exactly on the nose. There was a small loss on the census data, meaning the liability was a little higher than expected. But then because of that mortality assumption change that we're proposing, that canceled out the small increase of the data. So we ended up basically exactly where we expected to be. When we compare the assets to the liabilities, you can see that the unfunded accrued liability has been going down as you've been making payments to this plan. And the funded ratio has been going up nicely, so that you are at 92.4%.
Now, you would expect in the next 5 years that could hit 100 or close to it.
Yes, so actually, let's talk about the funding policy and what the future by looking at the next graph. So we have your liabilities, we have your assets, we put those together, and using a funding policy, we calculate an actuarially determined contribution. And that amount is made up of 3 pieces on page 5. The bottom green, that's the normal cost. Those are the benefits that your active members are earning every year. They work another year, get another year of service, they accrue a benefit, that's the normal cost. And again, like the member count, that's dropping. The next piece is what we call the past service cost. And that is your payment towards that unfunded accrued liability. So like we said on the previous page, there's 3.5 million of unfunded accrued liability. You're paying that over time. Think of it as a mortgage that you're paying off every year. And there's different ways to structure that mortgage, right? So what your funding policy is to have an amortization period that declines by 1 every year. So think of it like you took out a 30-year mortgage, you had 30 years left, then you have 29, 28, etc. So every year you're getting 1 year closer to having that paid off. And that mortgage was at 10 years as of the last valuation. And when we get down to a relatively small period, that introduces volatility, possible volatility into your contribution. Because unlike a mortgage that, you take out one amount and you know what that amount is, with a pension plan, that amount changes every year. If you have a bad asset year, all of a sudden you have new losses that you have to pay off, right? So you had a certain amount left to pay off, and then we have new experience, good or bad, that changes the amount of your unfunded accrued liability.
And that funding policy is also recommended by this board? Who sets
I
the funding
believe,
policy?
I don't,
I don't know, and I don't know if we've looked at it. Have we ever looked at it? And you have a longer track history with the bottom, and I do have a much longer track history with
It's
the
something we
mean,
did with the police plan. I think last year was when we reset the amortization.
Yeah,
period, and
I
it
know
was
we
approved.
reset the table last year for the police, and the board said that.
So this is something similar that we had talked about was upcoming as you reach 10 years. It is a change in the method, so that requires board approval.
Right.
And it's something we can put up. It was the strategy we had talked about last year, and it is just to mitigate volatility in the contribution. In the end.
I'm just trying to wrap my hands in, coming from the corporate world and the non-for-profit world where the contributions are set by rules of the federal
Yes.
government based on their assumed rate of return,
yes.
not your own. And also where the accounting assumptions are very different than the
Yes.
funding assumptions. I assume that in the municipal world, the accounting and funding assumptions are the same. Is that true?
Yes, that's true. Yes.
So in terms of how our books look is what I'm talking about here. It's our assumed rate of return that
Yes.
drives it, and our funding policy
Right.
drives it.
Yeah.
Okay, I just want to be sure I
Yeah.
understand.
That's
how
why
this
it's like-
works. It's very different than the world that
It is.
come out
Yes,
of.
you have more flexibility.
That's why it's so important of what this board's done over the last however many years to lower those assumptions, because we could have left them high
Right.
and it would have dropped their ADC every year.
Yeah.
And kicked the can down the road, but we haven't done that.
Right. We've actually done it the other way. We've gone to 6.5, which means they have to pony up a little bit more money than they would if we left it at 7 or 7.2.
Right.
So that's all helping it along with what kind of return we can get.
So that's your current funding policy. What we recommend is, now that you've hit that 10-year mark, is to go to what we call a 10-year layered approach, which means that you keep your current base. So whatever, you had an unfunded accrued liability last year, and you're amortizing that down. You have 9 years left on that payment this year. But for any new gains or losses that come up, you set up another slice, another layer that you also amortize over 10 years. So any new gain or loss that comes up, instead of amortizing it by whatever is left, 9, 8, 7, it's always 10. And then that piece is another new little mortgage that you're taking out every year.
So we never get to 100% funded. We
Well,
approach it asymptotically, but we don't get there.
In a perfect world, so if everything went according to our assumptions, there really wouldn't be any gains or losses
Right.
in the next 10 years. And so it'd still be 100%
Yeah.
after 10 years. So in theory, you're probably going to have offsetting gains and losses in the next 10 years. And really, it's just you don't want it to swing what you're budgeting by a big amount. And so we smooth that gain or loss, which is generally a lot smaller than the starting unfunded amount. But they tend to offset each other, and it's just little variation. It's usually not significant. And so you still approach 100% in the same amount of time.
Yeah, like, so in this past
With
year,
less volatility.
yeah.
Correct.
like, in the past year, the investment income was 4.1, the expected was 2.6, right?
So this is a,
If Morgan
yeah.
Stanley doesn't let us down,
Yeah.
we'll get to 100 because in essence, because we're being conservative with the 6.5, hopefully
Right.
conservative with the 6.5, is we will get there, but we'll get there based on the back of our investment income, not necessarily getting there because we pushed the ADC harder, right? The actual determined contribution harder.
The other thing you can't, dial in black swan events. So that's why you have the averages and you do everything you do to smooth those
exactly,
things out.
yeah.
Sooner or later, black swan shows
I've lived through similar.
up. So have I,
Right. And that's the
all the way
benefit.
back to the sixties.
No, I started in 72.
And that's the benefit of not continuing with just the straight 10-year or 10-year amortization. So if you get out of 1 or 2 years and you have a big fluctuation in assets a year, that it's going to move the contribution a ton.
So we continue to amortize the existing
Yes.
Yes.
gain or loss over the 10 years, but we start and
You add new little
it's
piece,
only
yeah.
10-year.
Yeah.
Makes sense.
So that's the calculation that we've shown here. So that would give you an actual determined contribution of about 800,000. So the normal cost is about 300,000, past service cost is about 450,000. And then there's that last little piece, which is an interest adjustment that we do because we're calculating the contribution for the following fiscal year. So we make an adjustment for that timing difference.
So even though the actual determined contribution is dropping by roughly 170,000, the general fund budget line for this isn't, because we have all the new hires are on defined contribution. So as their salary goes up and we had a couple of retirees last year, like somebody that made over $100,000, they retired. So they're drawn from the pension now. And now the town's gonna come up with 6% of their pay. It's another 6% that we need to budget for the defined contribution piece.
Right. This is just a piece of what
Yeah.
your retirement package.
And just because I like to point this out, this includes the board of ed employees that are on the town pension.
There are board of ed employees on the town bench.
Yes, so some of the office staff are on it, some of the old custodians are on it. Again, there's no new hires for them
But the
going into it.
teachers have the state.
Teachers are separate, yeah.
Yeah.
But the custodians that were hired before, I think it's 2015, 2016, some of them are in it. I don't know all those cutoffs, man. It's all in the different union contracts. Some of the office staff, the secretaries are in it, so.
Now, Brad, on that plan, do they have the option on there of putting their spouse on for contributions? So if they die, their spouse still gets it when they die, but they take.
Yeah,
that-
so when somebody retires, they get a number of options. The biggest amount of money they would get would be it's tied to their life. Something happens to them, it ends. As long as they've gotten back what they put in plus the gains. The next lowest would be it's tied to their life, but it's guaranteed for 10 years. We just had one of these come up yesterday. one of the sons of a former retiree came in. His dad died 4 years ago. His mom died this year, but they had selected the 10-year certain.
Hmm.
So the town still had to pay out over 30, the pension had to still pay out like $30,000 because it's what it was remaining from the 10-year certain. Then the next lowest would be it's tied to the employee's life. And if something happens to the employee, the spouse gets 50%. And the lowest one is it's tied to both their lives. So, like one of our retiree last year, his spouse is like 18 years younger than him. So his dropped by more than, if your spouse was 1 month older than you, just for random, picking people.
So on the last page, we just have a table of numbers for those folks that the pictures want to see. The results in number forms. It's pretty much what I already laid out, but if you want to see the details, they're there. Any questions before we go over the police plan?
So the board will need to vote on two things, the vote on the mortality and the amortization. We should go through the police first because the mortality affects both. It's a change for both. And then it'll only be an amortization change on the town side, right?
That's right.
Yeah.
So we should be able to cover a motion.
Do that at the end,
cover
yeah.
both of them. Okay.
Yeah.
Okay. The police presentation looks very similar. Asset return was very similar. The two key differences between the two plans, the police plan is not close to the entrance. New members are still coming into this plan. So that kind of changes the life cycle of the plan. And the funded ratio is somewhat lower for the police plan than it is for the town plan. The police plan is 83% funded as of this latest valuation.
Yeah. So Bob, you're here for it. Myra, I don't know if we've covered this before. A number of years ago, when we switched to Milliman, the old actuaries assumed that everybody retired the second they could.
Yeah.
So the police they hit their 25 years and say, thanks, see you later. The town side doesn't. So, and there was mortality change at the same point. So the police plan, when we made that change, the funded ratio dropped. But the town actually went up because you look at the chart, we have people here that are in their 60s and they've been here 35 plus years. Like they've been eligible for a long time. But there was a drop at one point. At one point, they were closer to being the same, and then that created a spread.
Thank you.
Okay, so just looking at the plan membership, you'll see, a different pattern. You'll see that you have about 44 active members, and that number has been slowly going up over the last 5 years. This is a smaller plan also. There are only 44 active members, 24 retirees, and you're only paying about $1 million in annual benefits. Only $1 million, but of course, still an important plan. And you can see that you do have a good chunk of younger, newer employees in this plan. The asset return picture is very similar. Again, the 3 good years, the 1 bad year, the 1 great year, all of that kind of smoothing out. We're ending up at asset value of $23 million on a market value basis and $22.6 million on an actual value basis. And then the return assumption is the same. So just for that slide. On the liability side, you can see more of that increase over time. When we were looking at the town plan, I said that it was kind of leveling off. That is not the case with this plan because you do have new members coming in and you do have a good number of active members that are accruing benefits. So we did expect the liability to increase. We expected it to be at 26.9 million. You had some data losses on this plan as well, meaning the liability was a little higher than expected. And that was primarily due to more retirements that our assumptions predict. And for this plan, the mortality table caused a small increase in the liabilities. just again, because that public safety version of the new table actually had longer life expectancy than prior table did. And you can, well, I'll show you the numbers in a couple pages on that. So this plan is also making good progress towards 100% funded. You can see the unfunded accrued liability has been going down and the funded ratio has been going up steadily.
You know how our funded ratios compared to other towns or-
The 80-90 range, I would give you B plus. You're really good. Not the best, but certainly.
It's the wild, wild west out there. Tiffany.
Yeah.
You got,
Yeah, they're all over the place.
I think the important thing is you have a good funding policy, you're contributing back to really determined contribution, so you're on track.
There are some towns in the past that had to put out special bonds to cover. They had to bond it.
Yeah.
I don't want to name some towns, but it has happened.
Yes.
That big change I was talking about when we made those changes that dropped it was 2014. So in 2013, the town was 68%, police were 71. We made the change, the town jumped to 80.8, the police dropped to 63.8. So even if you look at the town's gone up like 12% since then, the police has actually gone up 20%. But they had more room to gain too, so.
So we're definitely headed in the right direction.
Yes.
Towards, higher funding. Maybe we'll get to 90%. Especially if Mike can work miracles.
Put the OCIO to the test.
No pressure.
Although we can't blame it
Robin,
for
you
a
know what
black
the
swan.
assignment is now, right?
Yeah, black diamond.
And then another key difference that we kind of alluded to is that amortization period that we're paying off our unfunded over is different between the two plans. So while the town plan was already at 10 years as of the last valuation, this plan was at 14 years.
Yeah. So 2 years ago, they're both at the same.
Mhm.
There was a pension change to the police because we were having trouble hiring new police officers. So there's a tweak to the plan, which would have caused the ADC to jump a lot that 1 year. So we reset the police back to 15. We could have gone back to 20 or 25 or 30. But again, this board's been pretty conservative over time. We didn't want to have to eat it all that first year. So we wanted to make a slight adjustment, but didn't want to try to drop it artificially.
Yeah,
So you're not recommending a change to the amortization period for this plan because we still have a longer run. We're not to see that policy.
right. The 10 to 15 years is kind of the sweet spot. And that amortization period, the way you want to think about that is you want to pay off that unfunded over the expected working lifetime of that active member. You want, the correct generation of taxpayers paying for the benefits that are being earned now. So there's, 20 would also be appropriate, but like Brad said, you've chosen 15 years. That's conservative but appropriate assumption. And especially the other plan is closed and this one is open, so it makes sense for this plan to have a little bit longer amortization period. You have more active members and a longer expected working lifetime for them. You could consider with this plan also moving to the layered basis earlier, not necessarily waiting till you get down to 10 years. We didn't put that in this presentation. We can talk about that if we want to make the change all at once and use a 15-year layered basis for this plan and 10 years for the other one, or you can just let this one play out until it gets to 10 years.
Yeah, my recommendation is a $30,000 increase. Let's take the $30,000 increase and go, that's okay.
Yeah, it's
We're not doing anything to artificially drop it to just be a 30, but we're also saving options for if there is something that changes, that if we do have a bad event, you could go back to a 15 or a 20, to me, it's like saving bullets for later on.
Exactly, putting it in your back pocket.
Right.
Yep.
Yeah, and the other thing is, looking forward, there's no plans or anything to end this plan and go to a 401K because of the competitive situation. A pension plan seems to be the answer. Otherwise, you won't be able to retain people.
Yeah, it hasn't been ratified yet, so we can't talk about what's in it. But there's nothing that's gonna surprise you in the next police contract when it comes to the pension.
Yeah.
So, but that it is towns that have gone to like a hybrid plan or a full 401K. Some of them are flipping back, some of them aren't. And just like it's a longer vesting period too for the police. They have to put in 20 years to get anything. Whereas with the town plan, if you hire somebody at 60 years old, like they can retire after 10 years because they'll hit that rule 70, 75. Well, they can't anymore because it's closed, but if they did, so.
That's our whole presentation. There's some commercials and some disclaimers at the back.
So it's a recommendation to change the amortization schedule and the mortality tables, amortization for the town and the mortality. But a board member would have to make a motion to approve that. To accept Milliman's recommendation and make those changes as part of the presentation. The board could choose not to. I think they make sense. I think you'd rather not. Anytime you can update the mortality table, you probably should, as long as it's not. If they were pushing for a 2021 one and it made a drastic change, I'd go, well, let's wait. But moving to the 2016 pre-COVID, I think it just makes sense to make the move now. So, but it's up to the board.
Yeah. Any discussion on it? Anyone have any opinion one way or the other? Or?
I think we should make the changes. I think it's in the best interest of the town at this point.
No, I agree too.
I agree too.
We're unanimous?
Yeah.
Okay.
All right, so you need to make a
Somebody has to
motion
make a
now.
Yeah, so I make a motion that we make the changes presented for the actuarial table change.
Awesome.
All in favor?
All right.
Against?
Hold on, we got Paul.
Oh,
Yep.
Paul?
Are you in favor?
I'm in favor.
All right.
Okay, unanimous.
Unanimous.
Okay, so approved. Now, there's something else we should be doing here. Or is that it?
So for the actuary,
Okay,
we get to listen to Mike talk about the market and
Rob.
Robert.
okay.
I
Now-
figured, I didn't know you were gonna let
Now,
Robert.
there's
Mike gets going sometimes.
now, there's one other thing we've got to talk about next, the changes that you're suggesting there in the mix, I think.
Well, so, yeah, I mean, the investment policy statement, wealth strategies analysis, I mean, there's a couple things to get
Okay.
to before
So,
the last version of performance reporting that I'll do before the OCIO takes over or in partnership.
should we talk at this point about the investment policy statement update?
Sure, I think,
That would be appropriate, then go on to the investment part of it.
yeah, we had, as you all know, we are with OCIO now, Morgan Stanley, and we had the OCIO people, redo the investment policy statements with their language. Feel free to, if there's any changes that you want to make, and it's an ongoing thing, doesn't have to be done today, but if you're good with the updated investment policy statements, it's something that my compliance people check on with me every month. If there are any changes to the investment policy statement, and it's also with Clearwater Analytics, there's daily monitoring of the assets in the IPS. So if anyone has any comments, changes, approval, disapproval,
I just had a
Yep.
couple of
sure.
questions, suggestions, whatever. In talking about the duties of the investment advisor, we talk about, selection, manager search and performance monitoring, but we don't talk about termination of managers if necessary or if warranted. So I don't know exactly whether the place to put it is in that definition section or responsibility of the, investment advisor, but I just think, you're not just selecting managers, you're also making decisions to terminate if necessary.
That's absolutely right.
Just should be a reference.
Just before you click into the next thing, Maya, I just want to point out, because it's not on our agenda to approve the investment policy statement, we can't approve it today. It's a special meeting. It would have to go on the next agenda. Or we could have a special, but because it's a special, we can't add. And like, it's one thing to do the amortization stuff because that's part of the actuary report. Because it says performance reviewed of defined benefit plans and doesn't say anything about the IPS, the board can't vote on it today. I know,
Okay.
annoying stuff.
We
Okay.
gotta get
Yeah, I'm
this,
glad you
then we need
clarified
to have a special meeting
Yeah.
because we shouldn't let this go past the end. of the
No, we
year.
shouldn't.
Yeah.
But I wanted to bring it up because it's here.
I think we
There's a lot of
should.
changes
yeah.
that have been put in
Right.
here.
Keep going, Mara.
To bring it up.
That's-
We're taking notes here, so.
So the other question I had was on page 6, when talking about the target ranges and rebalancing. When I read this, and maybe I was reading fast, it implies that you only rebalance if we're outside the boundaries of our maximum and minimum for an asset class. Is that actually the case, or do you do rebalancing?
That's
Tomorrow.
not the case. We do tactical trades, as we see fit according to market conditions. But it's so that the IPS is just setting the guardrails that if we are out of bounds, we must rebalance at some, prudent amount of time.
Then the other thing, then I would put some reference to rebalancing in the investment advisor responsibilities,
Yes.
because we've got it in the guidelines, so that's how we make sure we stay in guidelines, but there's also this ongoing markets are moving. Do we let it run till we're outside our guidelines, or do we rebalance on some more period of
Okay.
basis?
Yeah, we have lots of language to that effect, so I can put
Okay, good.
something in here.
So what you're gonna do, any changes we recommend now, you're gonna do that. So when we have our next meeting, you can have that reprinted and then,
Yeah.
and then we can discuss it. And at that meeting,
We can redo it and I can resend it to Brad to send out to the members.
Yes.
right.
Yeah.
And then,
Myra's still got it. That's
I
right.
have but only one of them. I
okay,
promise. God, I've been through so many investment policy statements in my life.
Yeah.
And the fixed income maturity restrictions, I don't have a problem with that. But there's no target duration or anything like that on the fixed income portion. Is that typically how you run your accounts? Because I'm used to seeing some sort of a target duration on investment policies.
We typically don't have a target duration listed in the investment policy statement, no.
Okay.
These guidelines we maintained from your last investment policy statement.
Mhm.
They're prudent, they're consistent with,
Right.
what other clients typically have. We don't typically put a target duration, in part because we hire investment managers. We typically we're gonna hire 2 for the amount of fixed income in this portfolio, and we hire them for their strategies and how they would correlate or not,
Right.
So in
And
some
so each of
cases,
them might have a different kind of
exactly,
duration.
some like to be neutral duration, some might make duration bets, but we, monitor that and see how they perform.
But you would be setting target durations as the advisor, you would be setting expected target durations
Yes.
for the
For the
managers
investment.
that would be reflected in the benchmarks. You measure that.
Exactly.
And do you typically in the OCIO things have a maximum maturity? Things, I mean, there
Not-
are some 100-year bonds and stuff.
No,
not that I'm
it's quite rare.
in-
yeah. I think we have an investment statement not to exceed 30 years.
Right, and the question is why? I guess, do we need it?
Was it pre-existing? Is that why it's in? here?
Yes, we kept that. in
Yeah,
there.
I mean, I'm just wondering if they're not a little outdated, like a maximum, an average portfolio maturity not to exceed 15 years. That's what brought up the duration thing for me, because I'm not used to seeing guidelines that have maturity references in them.
Right.
We need them at all.
No,
And-
I mean, we need
Yeah, maybe their
quality
clients don't,
restrictions.
but-
I completely agree with that.
we can get rid of that piece.
Yeah. we can just- We'll give you a new version with different language.
Just the one thing I wanted to preface about the investment policy conversation is that you, there's now going to be two, one specifically for the employees' pension and one specifically for the police. You had a new investment policy statement as of January 24. So that's not very outdated. You know, we kept almost all of the language. We had to update the assignment of responsibilities, indicating that we now have discretion. That was an important change. We're changing the target allocations just a smidge, but we'll explain why when we get to the next section. We kept almost everything else the same, but you know, to the presentation we just heard, these plans have different characteristics. And while they still both have the same assumed actuarial rate of return, the dynamics are different and they're going to diverge over time. So by having two different investment policy statements, we can move in different directions if needed. So I mean, today they're the same language. We're still going to manage the portfolios basically the same, but you know, as the employees one gets closer to 100%, we'll likely want to de-risk the portfolio. So it's gonna
That's another reason for taking those maturity statements.
Yes. No, great point. Yeah, absolutely.
Yeah, no, that makes a lot of sense. And
I just
also
wanted to point that out.
liquidity is going to become more of an issue for the town employees. So I saw you
Exactly.
putting a smidge of the cash
Mhm.
piece in there, and
Mhm.
presumably at some point we might want that higher or short term.
Well, we made the 2% on there to cover, I think, what you figure we have for the cash needs. So we don't have to dip into any investments at any time and at inappropriate time.
Exactly.
But do you think that 2% is a reasonable number?
We do. For now, that's totally fine. And the secondary effect is it's lowers some volatility a bit. So it's, you know, serves a couple of purposes. But yeah, we
Okay.
kept a 2% strategic allocation sliver in cash.
And the other question is on the prohibited transactions that are in there. Do you see any changes in the language there? Or anything we should add or subtract? Or is that
There's nothing.
that's pretty standard?
Standard stuff.
Yeah. I just
Yeah,
wanted
I
to
mean,
know.
the only thing that would change was if you were to recommend, for example, that we use some hedge funds. It's like
Right.
that.
I might add what I'd language, digital assets or.
I'm sorry?
Bitcoin. Digital assets or Bitcoin.
I wouldn't want to.
No,
Yeah.
not add, I mean.
Yeah, yeah.
prohibit.
But we
Yeah,
have a
I'm wondering if we
prohibition
should
right
put that
now against
language in
short
there.
selling, for example. And
Yes.
if we decided, if you were to decide that we should use some hedge funds, we'd have to get rid of.
We would have to modify the IPS.
Yeah,
Yeah.
but should we put anything in there about Bitcoin or digital assets or just leave it out?
You're welcome to, if you'd like. I have
I'm
seen,
put it more under prohibited. All right.
Yeah, I mean, we're not gonna be recommending it. I mean, so,
No, we're not neither, not.
Yeah, yeah,
this
yeah,
time Anyway.
That would be a whole new asset class for us too.
Yeah.
Yes, it would be.
I would think that
So in essence, it's prohibited by not being,
we'd have to,
A
we'd
minimum
have
or
to
max,
approve,
right?
right, be in there.
Right.
Yeah.
I think.
down 30%.
But I don't have a
40
problem
days.
saying it's. prohibited.
33%.
That's 2% in 40
if you
days.
sneak it in, it could be considered there.
No problem.
If the average age of the board was 12, you'd all be into it.
But no, you're right.
Okay, so we can ignore that then, we don't have to put it. All right, so actually then what we'll do is you'll make that change and in our next scheduled meeting, we'll bring it up.
well, but, so the next schedule, that's the next.
January.
Is January 21st. You want to see, how long would it take you to update the agreement? Let's start with there.
I can send you this on Friday,
Okay, well, no bother, we're closed Friday, but.
Yeah. Monday.
So I think Myra would like to see, I don't want to speak for you, you'd like to see not wait till January to approve.
I
it,
would
right?
like us to start the new year under the new guidelines.
Okay.
So,
Alright.
Okay,
if possible, so that would mean just a special, a brief telephonic special meeting. Do we have time to do that under the guidelines notice, or, I mean,
You just need 48 hours,
okay.
so.
Maybe, sometime early
yeah,
December.
we can do it. Yeah, the first week of December or.
We could do a
that's
half an hour
possible.
meeting and just approve it.
Yeah. I think if we want to get this approved before the end of the year and have it effective, I agree. I agree, we should probably do that. It's important, and there's not a lot of changes yet. So.
So Ed, why don't you work with Mary on that, this pick a date? And she can reach out to the board to see when people are available.
Yeah.
So, but we'll wait from Robinson's, obviously, but we're gonna get it within a week. In essence, you could come back on like the second week of December and have a meeting and do it. Because if you do a special meeting with the only thing on it is approve the IPS.
Right.
And like, because of Zoom and everything, if like, just zoom into it, like you guys don't even have to come back down.
Yeah,
We
we
should
can
make
do that,
Scott
yeah.
go just because he loves IPSs.
Yeah. Well, we should be able to do that.
Yeah.
And I'd like to do it by no later than Friday, the 12th of December.
Right,
And I'll try to fit it in sometime between now and then.
perfect.
Okay, I made a note of that and I'll talk to Mary. Okay,
And so the next thing is the, wealth, sorry.
yeah, let's do
The
that.
wealth strategy analysis is, and I'll hand it over to Robin, but it's more or less that graph you saw done by Milliman, except it's 900 pages.
Yeah,
And it just go, again, based on the secular, the rolling 20-year period of the underlying asset class, which is how pensions do it, sort of backing into a proposal that can justify the return. So anything you want to add, Rob?
Sure, we can look to page 4 of the, behind tab 2. I think.
Yeah.
Yep.
It says executive summary on the top left. So there's two columns here. On the left is your current portfolio. On the right is the proposed asset allocation that we're going to move to.
mhm,
So just before we even look at the numbers, the bottom line is your portfolio has been managed, wonderfully. We're not making big changes. The numbers here are based on our Morgan Stanley's capital market assumptions, which we create at the end of March every year, a little bit more dated than Milliman's. So just so you know, these numbers are based on a point in time that were set in March for what we think different asset classes are going to perform and their risk characteristics. So, okay, on the left, we see current portfolio, you're 50% in equity, 40% in fixed income, and almost 10% in alternatives.
Hmm.
And that's REITs and MLPs. So this portfolio, based on the assumptions, would have an annual return of 6.9%. Standard deviation, Sharpe ratio, we'll compare all those to the right. We're adding a 2% sliver in cash. That's the new green portion at the top. Equities are going from 50 to 55%. Fixed income remains about the same, 38, because 38 plus the 2 in cash, that was your 40% fixed income. And we are maintaining the 5% in REITs. So what changed, basically the biggest change is we plan to sell the MLPs and put that back into equities. And the result of that is, the numbers are incredibly similar. So the annual return goes up a tick, the standard deviation in this page goes up a tick, but the Sharpe ratio goes up, so it's a bit more efficient, yield goes up a tiny bit. Again, these are very similar portfolios. We're not making big changes. We can look at number 5, page 5, to see the underlying sub-asset classes. Another thing to point out, we are planning to reduce the allocation to small and mid-cap stocks and put more into US large cap stocks. In international, we are increasing a little bit, and we're going to split that and add some to emerging markets. Fixed income, again, you'll see the change at the bottom. The MLPs will go away.
Robin,
Yes.
you want to talk about the reallocation in terms of the size ranges on US equity?
Yes, we are moving away from small and mid-cap publicly traded stocks. That sub-asset class has sort of undergone a change in its long-term characteristics for a number of reasons. A lot of companies are staying private longer. They're not coming to the public markets. There's a lot of biases with survivors and non-survivors. So the good small cap companies move up to mid cap and they move up to large cap. And the, ones still in the small cap index are unprofitable and not doing well. So we've seen over time, we've just become less excited about small and mid cap stocks in general, publicly traded stocks. And, the kind of corollary to that is that private equity has boomed and become a much bigger industry. And as companies stay private, you know, what would have been in the small cap index is now in a private equity fund. So that's sort of a, you know, big picture why we're not as excited. And also US large cap stocks have just been so dominant, and we like to increase exposure in that area. So it's like a little bit of less here and a little bit more there.
As we know, of course, the large cap area is the hardest place to beat the market. So would you be allocating some of that to an index fund, or would it all be active?
No, so this is the asset allocation study. The next section is the actual portfolio, and we are increasing passive exposure quite a bit. In large cap, we typically do 80% passive now, 20% active.
And the best performing sector year to date, everyone is surprised, it's international markets.
Hmm.
Who
Emerging
saw
markets, yeah.
that coming? Nobody.
Right. If you could flip ahead to page 11. It says summary performance statistics at the top. So the page we just looked at was based on a one-time, you know, our capital market assumptions. But this page is based on a Monte Carlo analysis. So this actually does 10,000 simulations, you know, it stresses, there's up years, down years, and comes to an assumption for it. So in honesty, it's a more realistic assumption of the performance of the portfolio. So at the very bottom, you'll see, you know, with the 95th percentile of scenarios, the result of the current portfolio is, you know, so 95th percentile, so very good, you know, over time. The annual rate of return would be 9.7%. And then the proposal would be a little higher, 9.9. So really, you want to look at the 50th percentile to get where, you know, what we're aiming for. So the current portfolio, right on the money, 6.5%, and proposal, it's up a little bit, 6.7. And the next page, 12, this is a probability analysis. So, and again, these are long dated out to 2044. The probability of achieving the actual rate of return over time. The current portfolio is over 50, which is what we want. We're upping it a little bit to 53.2%. And some people look at this chart and they say, what? You only have a 53% chance of, you know, probability of meeting my goal. But yes, you know, markets, you want to be about 50-50. If it were closer to 100, it means we are way out of line in asset allocation, way out on the risk spectrum. You know, we're going to earn 50, you know, 40% every year returns. That means we're taking a massive amount of risk. So actually getting just a little over 50% is exactly where you want to be. The rest of this section is just lots of different analyses and ways to slice and dice it. You can, you know, look at your leisure. There's different years. You could see how each would have performed. But this is just the asset allocation. So if we go to the next tab, we'll look at the actual manager's holdings. So behind the next tab. Oh, and yeah. So we can.
19.
Oh, yeah, sorry.
Yep.
What tab are you?
19 on tab 2, because we got section 3. It's broken
Oh,
out by
got it.
plan.
Sorry, I flipped ahead.
Yep.
19.
Yeah, in that same tab.
Okay, yeah, I see that.
I'll actually start on 18 just to show you real quick. On the right-hand side, in addition to the benchmarks compared to each manager. So you see your performance report, and there's benchmarks for the asset classes you're allocated to. We are also introducing a static strategic asset allocation benchmark. So in addition to what you have typically seen, you will also see a static benchmark that is 2%.
I'm sorry, Robin,
Oh,
what
sorry.
page are we on?
I'm on
18.
18 behind tab 2. It says investment policy.
It leads right from,
I was following
yeah.
on my.
Yep.
After portfolio construction analysis, yeah.
Yes,
Yes.
yes, the first page after that. Just pointing out, we have a new static policy benchmark that we will show you each performance report. And it's 2% in the cash benchmark, 55% in the MSCI ACWI, which is all country world index. So that's global stocks. 38% in the Barclays aggregate, which is the US bond market. Sorry, it's the US aggregate, not global. And then 5% in a REIT index. So having this in addition to the benchmarks you've typically seen is just to gauge our, asset allocation tactical bets. So 19. So one thing I wanted to point out is we are increasing the amount to passive exposure quite a bit, particularly in large cap stocks, because they have very poor performance for active management, especially lately. So your portfolio is currently 82% active, 18% passive. We are moving that to 2/3 active, 67%, 33% passive.
And those are through Vanguard ETFs
Yes.
on Aspire.
So we're adding Vanguard Growth
Mhm.
ETF, Vanguard Value. We're adding some
Really
passive
value
and
ETF.
international and emerging markets. So I'm not sure if it's helpful I don't think I need to go through each of these managers. I think, when the first performance report comes around, we can talk through each one, but in general, the changes we wanted to make were increased passive. We sold out of MLPs. If you happen to notice on Yelena's chart, the MLPs are the most volatile pile of sub-asset classes. So we wanted to kind of remove that tail off the risk.
Did well for the town for the last.
Oh my
5
gosh,
years.
no, in good years,
Yeah,
MLPs.
yeah,
rip.
no doubt. Yep.
So over time, as we report, you'll
Yeah.
get familiar with these managers. We'll tell you, we are maintaining some, by the way. We're keeping Causeway, we have ClearBridge, but we're adding a number of new managers.
The only question that I would have is on the emerging markets, where you're making more than half, it's only 3% debt, but you're making more than half the emerging markets exposure be passive. And that's not something I'm used to seeing.
True, it historically is the most inefficient,
Right.
sub-asset class.
So what's the thinking? What's Morgan Stanley's thinking?
Part of the thinking is just honestly, the abysmal performance of the active managers lately. And in many areas, increasing passive because just getting whipsawed, and there's certain dynamics that, like the dollar, swing this year is quite unprecedented. And there's other things like in small caps, stocks linked to digital assets and crypto and are ripping, and any active manager that has a quality bias is not going to own any of those names. There's a lot of dynamics like this that are making active management not perform very well lately. So we tend to split it these days. I know that's not the historical common wisdom.
Yeah, it's just unusual.
Yeah.
But that's subject to change as things evolve.
Oh, yes.
Oh, yeah.
I mean, this is your thought at the moment.
Yes. And now that we have discretion, we're free to make changes mid-quarter. We don't have to wait to, get the board approval on anything. So we will be actively trading, not excessively, but actively managing and trading this portfolio. That is my presentation on this. The next tab it's going to be identical, the police. We don't need to go over those, just a smaller portfolio.
And then the performance update as of September, if I can move on, as
What tab are
of
you
September 30th.
Tab 4.
I'm sorry, what?
Yeah.
It's after tab 4.
Yes, that would be, sorry, guys.
Yeah,
Tab 4.
Okay.
So these are our September 30 numbers. The town plan up 9.65, gain of 3.8 million. You guys are comfortable with the existing asset allocation, and that's going to change. It's always fun to look at stuff. If we were all stocks, we'd be up 15.74. If we were all bonds have come into their own here, up 5.14. Alternatives up 4.47. Gonna be the same, and again, this is the last time we get these skinny down reports with police. Up 9.64 as of 9:30. Really, 2022, second worst year of my career. And you look at the annualized performance since 2019, 7.61. So if we were all stocks, we'd be up 15.73%, bonds up 5.13, alts up 4.5. And I'd say the last comment is on LoSAP, Brad, that we need to eventually,
You can start funding for it.
yeah, so that, I mean, that'll be for something to talk about for next year, but it's time to start. The LoSAP, by the way, is not a pension plan.
No.
It's a length of service plan where the fire guys, based on 5 different types of career, they have to go on, when someone's in an accident, they need to go, and that counts. And there's all different, Brad and Bob, you probably know them better than I do. The annual things they have to meet to get years of credit. And so I think the LoSAP plan, it's certainly time to, talk about it for next year for funding. So just planting that seed. But again, it's not a pension plan, so there is no action.
But we haven't been really funding this, have we? We've just
So
been internal.
we used to fund it as part of the budget. And then we stopped because there's plenty of money in there because it wasn't getting drawn down and it was growing. Now the drawdowns outkicking the growth.
Okay.
So because we've had more people come off, but without really knowing when people would collect it, lifespan, all that, we probably let it go a little bit too long, but we talked about it last year, but we were too far into that budget. So we need to start budgeting for it in the 26-27 budget.
Okay.
So how many people, Brad, are on the plan? How much are we paying out?
We're paying it, last time we looked at it, Mike, I think we're paying out $100,000.
It's $100,000 a year now.
Okay. So this is going to start to,
Yeah, and I think there's like 6, what's in it, Mike? You have it right here somewhere.
590,
524.
524.
Yeah, 524, 781.
So,
So in other words, if we don't do anything, that's gonna evaporate eventually.
And the max annual monthly benefit is 250, 300, sorry. And you can go into the history if you want, but it's been quite the history.
Yeah.
so it's
No, it's
locked. So there's no new entries into it. The town is looking at other options for firefighters, like reward them for what they do for the town, but this program is locked. But the group that is locked is getting to the point of being 65 or when they're eligible for it. So we got to start funding it. Honestly, we're gonna limp into funding it because we're going back from zero. So I got to put it. I'm opening my budget book right now, so I remember to do it. But in essence, I'm probably going to fund it to the tune of like 30 grand this first year. Know that between the 30 and the growth, it's not enough. Maybe I'll do 50. But I don't want to go from zero. We got to get it back probably up to 100 at some point. But there is a balance there. You don't want to put so much money in there that like this program ends and now you're sitting. It's not the worst thing in the world, but like you don't want to take taxpayer money to fund this if you don't need it. And it's never been part of the Milliman doesn't look at it for us, which we don't need them to because it's always been smaller. But we got to start funding it again. So.
And
No,
from a management point of view, since we've sort of mirrored the allocation. that
We'll continue to do that unless, yeah.
So would we switch to the same allocation
Yep.
that we're doing with pension
Yep.
funds?
Yeah, we'll do that. Brad, so we should put this on the agenda for the next meeting in January. Because if you're gonna be making some decision on when to fund it, our next meeting after that, I think April or something.
Yeah, honestly, right now I'm gonna put in as a placeholder $50,000 to fund it for this year.
Do we need to?
How we
approve
fund it, I don't think that's a board decision necessarily.
Now, do we
Okay.
need to approve a change in the investment policy for the LoSAP to conform with the investment policy for the other two plans?
Well, the LoSAP's not in the ICO, right? OCIO, whatever.
No, it's not.
No,
But if we're
no.
saying we've in the past mirrored the
Yes.
investment policy,
Yeah, that's easy to do. So,
you know, yeah, we're not gonna put in anything about the OCIO. and
Right, right.
I'm talking about the asset allocation.
we can do that. I mean,
Yeah. But these are made up of all mutual funds.
yeah, it's look at the size of the account. I mean,
So
Yeah.
it's basically a passive managed mutual fund.
it's got a lot of it. Yeah, I mean, so it's
It isn't.
it's been a quagmire is what it's been.
Yeah.
I mean,
It isn't all passive though. So
no, it's not all, it's not all.
Not all passive, okay.
does it have an investment policy statement?
It was sub in the old one. So what I can do is recreate and just keep it real straightforward.
That would be,
Yeah,
that'd be great.
The next-
Maybe,
I can.
Yeah, but then we should take this up then, in the next meeting, though, really.
Yeah, you can do that. If Mike has it ready when the other eye,
I will.
Yeah,
we can
okay.
just do both at the same time.
'Cause when's our next meeting? It's January.
The next one, well, you gotta cover that in your.
Yeah,
next
we gotta
topic.
cover it, but I don't have that sheet in front of me.
According to the proposal, it says January 21st.
Okay,
But if we're gonna do a meeting before that to do the investment policy statement, we should just do the investment policy statement for LoSAP at the same time.
yeah.
okay,
I don't think this board, because this board doesn't vote on the town budget for what we put in for the ADC. I always put in the full ADC. But I don't think we've traditionally ever voted on, I don't get to vote, but like setting what the town puts in. It's setting what the ADC is in essence by voting on the different rulings of it, but I don't think you necessarily need to vote on us funding it.
okay.
So what are we gonna aim for, Mr. Chairman, in terms of the meeting for approving the investment policy statements?
Well, that's sometime before the 12th of January.
Right.
Second week in December, maybe.
Yeah, would have to be the second week before the 12th Friday is the end of the second week.
Yeah.
So we want it that week.
I could do it Monday, Tuesday, or Friday. I can't do it Wednesday, or Thursday.
Bob doesn't want to do it Wednesday anyway.
What's that?
You don't want to do it Wednesday, it's your birthday Wednesday.
Hey, there you go.
39
hours on a Wednesday.
Is it 39?
So right now for me, Tuesday the 9th would be best,
Okay,
but
so
I'm not the be all end all.
why don't we do Tuesday the 9th then? Still 1 o'clock?
Yeah, and I'll talk to Mary about,
Okay, so let's say we do Tuesday, 1 o'clock, special meeting to cover the LoSAP and to cover the investment policies.
And we can do it virtual, right?
Paul, are you available on the December 9th at 1 PM?
Yeah, I should be around.
Okay,
Okay, good.
so
So
just,
we gotta get a form.
yeah,
Well, you're available.
That's right.
Okay, and I'm available, so,
I'll talk to Mary about that date.
okay,
and
yeah,
get it
let's try to
scheduled.
do that. All right, before we get to approval of the next year's meetings, we have to make a vote on this for the, changes of,
No, because it all falls in the IPS,
That's what we're.
the
gonna
current
do.
one.
yeah, the current one.
So no, you don't need to vote on it. It's just, and you don't need to accept the report ever under Robert's rules. You just have to
Okay.
Vote on it.
All right, so we don't need to do that, so you're just gonna go to that change then, we don't have to approve it. But you'll work with Brad on that. Do that. Because I noticed when you look at the changes out over the years, the police change adds up a little more than the town does. The town is small in comparison to the police, probably because they're, a continuation plan.
Mhm.
And building, it would make it, going out more. Okay, I think the next thing we've got then is the consideration of the meetings for next year.
Yeah, so Mary had sent out a meeting schedule that has January 22nd. It's still the third, meets quarterly, the third Wednesday. So those dates,
First.
yes, 21st at 1 PM. Then she has a note on here on April 15th, it's tax day.
Yeah.
I know that's hard for a couple of our members to do.
No, the 15th is impossible. for me.
Yeah, so, well, I was being nice, I was saying hard. So what we can do is not schedule the April 15th one, and if we need to do a special, do a special. Or pick a new date now, but I think it probably makes more sense just to do a special if you need one,
Well, we can do it the next, what's the next Wednesday?
would be the 22nd.
You know, why don't we put down the
All right,
22nd?
so you want to schedule a regular for April 22nd?
Yeah, let's do April 22nd.
All right.
Because there might be some things in there on the insurance part that we might want to cover
Yeah.
for the upcoming budget.
Well, by that point, hopefully the budget's pretty far along, but yeah, well,
Okay.
but if we need to, we can talk about
But
it.
we can also put that in the January meeting too on
Yeah.
insurance.
And then July 15th. And then we always go 4 months between July and November,
Right,
just to give Milliman time to do
the actuarial.
the actuary report.
I can tell you now that July 15th is gonna be a problem for me.
All right,
So I have to be out of town on the 14th and 15th for
Alright.
another board.
So we can change it to the next, Wednesday. When's the next
22nd.
Wednesday?
Yeah.
Well, let's make it July 22nd.
the summer one changes sometimes anyway, it's just hard to get people because of summer vacations, but we'll make the change now to July 22nd.
Yeah, let's do July 22nd.
Okay,
And then the next one will be November.
November 18th.
Okay, November 18th at 1 PM.
Yeah, and then for whatever reason, we always put on here the following January.
Okay.
Then at next November's meeting, we'll vote on a January date again.
I'm
Okay.
sorry, November 18th is a Connecticut Investment Advisory Council meeting, state meeting that
All right.
I could do
I,
before or after.
Should we do the one before? Is that too soon?
ask your friends to your right there.
Yeah.
Well,
What's the proposed date?
So if you did it November, well, no, because the week before is gonna be Veterans Day. You'd have to switch the date.
In a week after Thanksgiving?
And then,
And we're running into Thanksgiving.
yeah.
We can we switch the day?
You
Yeah,
could
we can
switch the
switch the
day.
day.
You
Keep
could
it the
do-
week of the 18th, but maybe do it the 17th or the 19th, Tuesday or
Yeah.
Thursday.
Yeah, we could do the 17th.
Alright.
So why don't we make that the 17th?
It's for this.
So that would be November 17th at 1 PM.
Yeah.
Yeah.
And then the January one would be what
The 20th.
the 20th. Okay.
Yeah.
At 1 PM.
so 121 for this year, 422, 722, 1117, and then 120,
27.
27. Oh my God.
Yeah, 27. Yeah, the time is passing.
So,
Calendars march on. We just march with it.
5 investments.
Okay, so those are the dates. Do I have a motion to approve those dates?
So moved.
Second? Okay, all in favor?
Aye.
All aye.
Yeah.
Okay,
Yeah.
motion passed, unanimous. All right, let's see,
Comptroller's update.
controller's update is the next thing.
Obviously, we're already an hour and a half in. There's really not a lot right now. I'm building out budgets, but if we're not to the point that we're getting renewal rates for our health insurance and other insurances yet. But we're starting to look at all that stuff.
So we'll have that for the January meeting.
Yeah.
I think.
Hopefully, yeah.
Now, we still have a situation where there's 1 or 2 carriers.
So right now, we have one carrier for active for health insurance, it's United. We have one carrier for the workers' comp and lab, which is Kerma. Kerma, we have a rate lock, or we have a max for our lap, our liability, auto and property at 5%. Hopefully it comes in under than that. And workers' comp, nobody will do more than 1 year at a time because of the volatility in it. So, but we've had good claims history on that and it's been actually coming down. So hopefully that continues.
Well, that's good.
So,
So how do you budget, you're planning your budget, not to be a big increase in that area, I take?
so I'll get, before we do, so just quickly what the budget process is. All departments do their initial budget request in December. January, they all meet with Dan, myself, and the assistant, it'll be finance director soon, but assistant controller, to meet with all them. February, the department heads present their budget to the Board of Selectmen and Finance. Late February, early March, the boards deliberate, and then it goes to a public hearing. So we'll get preliminary numbers on all those in January. And then before the deliberations of the boards, we try to have the carriers tighten them up. Usually they give us hopefully what's the worst case, and then we can tighten them up and they go down a little bit. But we have a couple of the bites of the apples to get it as we get closer to the renewal. Because even at the annual town meeting, you can't increase a budget, but you can lower it. So I think we've had years that we knew something came in lower, that we've taken that. You have to have somebody that lives in town get up and make a motion, but people are happy to get up and make a motion to reduce, knowing that we got a better rate on something. So budget feels really far away for most people, but it's not for me.
Yeah.
Brad,
So-
did you get a new title
So in the
in charter?
In the charter, one of the things is to update the comptroller title to finance director. Data processing is now IT. There's a couple other things they did. Technically, I'm still comptroller until December 4th.
Oh.
Because it's,
That's what
any
you do.
charter change that votes on takes 30 days until it becomes official. So,
Congratulations on your.
thanks. It didn't come with any more money, so.
I'm sorry.
You know, change the thing, Brad. You got a title change, but nothing else.
Yes. So that's the comptroller's update.
Okay, no other business. I vote for adjournment. Do I have a motion for adjournment?
So moved.
Second, all in favor?
Hi.
Adjourned.
Thank you, everyone.
Oh, I got through it.